Hi, my name is Frank Cianella with the Global Center of Excellence for Analytics, and I want to present this topic to you today, Strategic Topics in Finance. It's about transfer pricing. So my objective with this presentation and recording is to introduce you to the topic of transfer pricing, run you through a quick whiteboard as to what exactly is transfer pricing, and to provide you some key understandings around why this is important to you and why it's important to your customer. So from an agenda standpoint, I want to cover the following points. Why should you and your customer care about transfer pricing? What is it? That's the whiteboard session I referred to. What selling motions are best? So what's going to be most advantageous to you to sell this? And who do you engage? So what global resources are available to you and what regional resources are available to you to help you engage around transfer pricing? So first, why should you care? Why does your customer care? So in short, really, optimizing transfer pricing structures really allows organizations to drive to a lower effective tax rate. And by driving to a lower effective tax rate, huge annual savings to the bottom line are driven because of that. This allows customers to have an optimized effective tax rate that's not volatile, that stays relatively flat and helps them forecast and simulate what the impact is to the bottom line. And customers are doing this already today. It's not like you're introducing a brand new business process or work stream. They're already doing it. So you may be asking yourself, what's the value SAP provides? What SAP provides, the value SAP provides to this, is that we provide a solution that's transparent, it's auditable, and one that enables the customer to demonstrate how they set their transfer price and allows them to perform the necessary allocations and distributions of costs to the different entities that allows them to set that transfer price. And it also allows simulation around different scenarios and what-if capability. So again, that SAP value is all about providing capability and a solution that's transparent, auditable, and allows the customer to demonstrate how they set their price. Very important talking points because that becomes very crucial to organizations when the regulatory agencies come in and they want to know how is the transfer price set and provide us the visibility into your process. There's a huge market potential around transfer pricing. Every single global company, regardless of the region they operate in, operates in a manner that they have transfer pricing. And just by definition, transfer pricing is nothing more than the price organizations set internally to sell goods or services from one of their legal entities to another one of their legal entities. So I'm going to walk through the whiteboard to give you a great example of that. So again, huge market potential. We have smart, motivated partners. So Ernst & Young in North America and perhaps in Germany. PwC in the UK and Ireland markets right now. And these are global partners, and we're engaging with their tax advisory practices. So we're not engaging with their SAP practice, though it's a great place to start, but we're engaging with their tax professionals. And that's important because transfer pricing typically falls within the domain of the tax department. And these partners bring credibility to the tax departments. SAP, we're not going to have a strong credibility, strong footprint in the tax organizations within our customers, but these partners do. So it's best to really partner up with them. And the assets that we're creating with these partners will absolutely be shared globally once they're finalized and available. And one of the great things here for you is the solution. So this transfer pricing scenario is built off of profitability and cost management, or PCM. Resides in the EPM portfolio, mature product, has the proven capability, and you know it. This is just a different use case for PCM. And the market today is wide open. Vast majority of customers are using Microsoft Excel, Microsoft Access, and other ad hoc tools to really set their transfer prices and provide the transparency, which is very difficult, right? We know that with these office automation tools like Excel and Access, the transparency, the auditability, it's just not there. So organizations spend huge sums of money on a regular basis engaging with other consulting firms to help them understand these processes and to provide the documentation around that. So again, with PCM, we have a solution that's transparent, it's auditable, and it allows the customer to demonstrate how their transfer prices have been set. So very, very critical, important topic for you and your customer. And we're talking huge savings here. Double-digit million, up to three-digit million annual savings driven to the bottom line because of transfer pricing strategies, and now we provide them the capability to really realize those. So let's get into a quick scenario. So transfer pricing 101. Let's look at an example company. This is a consumer goods company that manufactures and markets and sells an energy drink. This consumer goods company has a supply chain that spans multiple countries, and all those countries, of course, tax the consumer goods company at a different rate. Further, the consumer goods company must have an at-arm's length transaction between its own legal entities. That means that they must have an agreement and a transaction just like they would with a third party. So that price that's charged from one entity to the other, as I said before, that's called the transfer price. The consumer goods company has a strong desire to have the lowest effective tax rate to the organization. And finally, this is a scenario that plays out at thousands of companies every single day. So just a quick scenario. Let's walk through it. So the first thing we have to do here is look at the physical flow of goods of the energy drink. And it's quite simple. We're going to manufacture a key component or a concentrate to the energy drink in Ireland. We're going to ship it to the dock. We're going to send it overseas to our facility in North America or the U.S. In the U.S., we're going to do some further processing, maybe add water and bottle that energy drink so that we can sell it then and ship it to our customers. So a fairly simple physical flow I've outlined here, but I think you get the idea of a cross-border transaction takes place, and ultimately that goes to the end consumer, which for this consumer goods company, their customer happens to be Walmart. So step one, the consumer goods company manufactures the concentrate, which is a key ingredient of the energy drink in Ireland. And this is done by their manufacturing company. And why is this important? Well, Ireland has a corporate tax rate of about 12.5%. So very friendly corporate tax rate, which is why we want to have a key ingredient manufactured here in Ireland. The manufacturing company then ships this concentrate to be converted to the energy drink. The conversion is done by the mixing company. But again, these activities are taking place in Ireland. Of course, it's going overseas to the U.S., as we talked about before. So again, that corporate tax rate is 12.5%. So along the way, the organization is incurring expenses to add value to that product. And in this case, it's transportation expenses. This mixing company is located in the United States. Therefore, a cross-border transaction has taken place, and the manufacturing company now has revenue to offset their manufacturing costs. Right? This is the at-arm's length transaction I referred to. However, the corporate tax rate in the U.S. is 35%. So a big difference between the U.S. and Ireland in their corporate tax rate. So following in our process, the mixing company, now located in the United States, produces and bottles the final energy drink, and they incur costs along the way as well. Additional manufacturing and conversion costs, transportation costs, all of these costs add value to the product and need to be allocated to the necessary location. Again, this is being done in the U.S. with a corporate tax rate of 35%. Additional transactions take place within the company. So again, these are intercompany transactions. And in this scenario, the mixing company then sells the energy drink to the sales and marketing company. And the sales and marketing company is going to incur additional costs to sell the energy drink. These are going to be sales and marketing expenses. And again, all taking place in the United States. And the final piece of the whiteboard here is that the sales and marketing company sells the product to the consumer goods customer, which in this case is Walmart. Again, incurring, the U.S., it's all done in the U.S., so the corporate tax rate of 35%. So we see now that, the goods certainly have followed a physical flow pattern that I laid out earlier, but there's been a lot of intercompany transactions taking place to get that, key ingredient from Ireland bottled and complete manufacture in the U.S. and shipped to the customer in the U.S. Could also be shipped to a customer in Canada, for example, or in the Bahamas or in the Caribbean, different countries there. So you can see how this can really manifest itself through multiple different borders, but for simplicity's sake, we just kept it between Ireland and the U.S. So let's recap what's gone on here. So the objective, again, was to have as much of the total corporate profit attached to the manufacturing company in Ireland because we really want to leverage that 12.5% corporate tax rate. Let's assume the consumer goods company makes a profit of $100 million in this example. And if it's all taxed in the U.S., that's $35 million of taxes have to be paid because of the 35% tax rate, and there's a net profit of $65 million. If the company leverages corporate tax structure and tax laws, which, by the way, all this is vetted out with tax attorneys and tax accountants, we can see now that if we can realize only 25% of the profit taxed in the U.S., our taxes there would be about $8.75 million. If we have the remaining, or 75% of the profit, taxed in Ireland at the more friendly 12.5% rate, we have incurred taxes there of about $9.4 million, which gives you a total taxes of about $18.15 million and a net profit of $81.85 million. That's a huge difference between taxes of $35 million. So really, in effect, the annual savings to the bottom line are just under $17 million. And these are relatively small figures when you start talking about multi-billion-dollar organizations that transact like this every day. So, what's the so what? It's big-time annual savings driven down to the bottom line, and it's because the company was able to reduce or lower their effective tax rate. And again, the key point in where SAP PCM comes in, it was done in a manner that's transparent, auditable, and where the company is able to demonstrate how they set the price and how they perform the allocation and distribution of all those costs, the direct costs and all those value-added costs throughout the supply chain to the different entities within the consumer goods company. So you can now start to appreciate and understand why this is such a huge issue for corporations. We're talking about huge savings to the bottom line. I'll give you an example of a consumer goods company I worked with in the U.S. They were driving $200 million plus annually to the bottom line in savings because of the transfer pricing processes and structure. And we were providing solutions to them that were helping them make sure that it was auditable, transparent, and they could demonstrate to regulatory agencies and other authorities exactly how they were doing it. So huge, huge savings to the bottom line. So quickly, now that we understand kind of what transfer pricing is, how do you go about selling this? Well, one of the key ways is to go joint with a partner. Again, that partner is going to bring the deep subject matter expertise, they have credibility, and oftentimes they have a relationship already in the tax department. The great thing is the target buyer is the CFO, right? The VP of tax, the corporate FP&A are buyers as well, and they of course report to a CFO. So we're not deviating too far from our strength, which is the CFO. Of course, the VP of tax is involved, but that's where the partner is going to help us out a lot. Like I said, in North America, we're already engaged pretty heavily with Ernst & Young. We're starting to go down that path with the PwC in the UK and Ireland, and would love to extend these relationships across other borders. We're already doing some account planning with them in certain cases as well. Of course, the AE can go direct. It's best through some sort of finance transformation or art of the possible workshop. We have some examples of that where we're engaging and talking about the transfer price scenario. Think of a target buyer. Of course, it's the tax department, it's corporate FP&A, but it's also product costing teams. Oftentimes, the product costing team in an organization is going to be charged with understanding and setting up these transfer pricing schemes across the different legal entities. This is relevant for most industries, but it seems to be heavily dominated in manufacturing. So automotive, high-tech, chemical, the life sciences industry, consumer goods industry. So you kind of get the idea. It's across many, many different industries. The multinational SAP customer is going to be your best target. And when you're engaging with your customer and you hear words like transfer price, royalty charges or payments, licensing intellectual property or IP, buying IP from one company to the other, intercompany transactions, those are red flags and key words that tell you their organization has transfer pricing. And they have structures and strategies behind that. So those are kind of your entrance ways, your wedge to kind of introduce the topic. So from a resource standpoint, leverage your regional center of excellence resource. I have them listed out here on the slide. Again, from a global standpoint, feel free to reach out to myself, Frank Cianella, or Cindy Dodd in the Industry Business Development team. More than happy to help you learn more, help you drive go-to-market strategies. We're really taking this forward here in 2013. Leverage your existing PCM pre-sales resources. Solution management, Jeremy Brunet is the global solution owner for PCM, and leverage your partners as well. We're in the process of completing a sales kit with a bunch of different assets, but I wanted to get this video out to you as soon as possible. And the simple thing is you can go to the Khan Academy. I've got a link right here on the page. It'll give you a real short 7-minute video on the intellectual property use case for transfer pricing. So another kind of whiteboard presentation that you have at your disposal to learn more about the topic. Hey, that concludes the introduction and whiteboard on transfer pricing. Hopefully it started you thinking about how you can leverage this in your customer base. Any questions, my contact information is right here on the slide. Again, my name is Frank Cianella, and I'm with the Global Center of Excellence for EPM and finance. Thank you.